while taking steps to support the rupee and boost dollar inflows. Bitcoin is currently the talk of the town as traders eye the $60,000 level after a volatile week. Keep a close eye on the U.S. jobs data coming up, as analysts suggest there is still upside risk for the greenback if the numbers surprise. For now, the FTSE 100 is holding on to modest gains of 0.4% as we head into the afternoon. Biggest movers right now, Ethereum, Hang Seng, ASX 200, and Bitcoin are down. High yield bonds is up.
Cool. What a review, huh? Amazing. So for those that are not familiar, that is Aiden. Sounds a lot like me because I cloned myself. Yeah. And Aiden, our artificial intelligence, does not use ChatGPT. It doesn't use Gemini, doesn't use Claude, doesn't use Perplexity. It doesn't use any large language model. It is our large language model. The only thing it knows is how I analyze macro fundamental economics, and it knows how I trade technically. And we pull data from 15 different central banks and government agencies around the world. We're watching prices of 72 assets in real time and pulling it all together in a giant neural network of buy, sell, hold, kind of basically, right? So it's specifically designed around the two questions. What would Wayne think? What would Wayne do? It's cool. And it has no connection to the internet. The only thing it is connected to is our database, but it is using machine learning to analyze relationships between all these assets and risk and market conditions. And it's also not just doing market sentiment. It's not just doing fundamentals. It's not doing just technicals, but because we have our own news feed, and it's this one here.
Gold steadies as traders await US NFP for clues on the Fed next move.
Canada unemployment rate forecast to remain unchanged in May.
So 24 hours a day, 7 days a week, he's reading investment headlines. He doesn't care about what the writers of these articles say or think, because I don't care what they say or think. They're journalist majors. Who cares? But the headline is important of, this is happening in Canada. This is happening in the Strait of Hormuz. This is happening in New Zealand. Hey, this person just did a speech. And Aiden pays attention to all that and pulls it in and says, oh, well, that's interesting because this asset's going up and this asset's going down and the risk scores are changing as this information is also coming across the headwire. So he can put everything into context too. It's really extraordinary stuff. Took years and years to build, but here we are. Quite amazing. So let's go back to the sit rep. 75.5 on the S&P. We've been here a while. We were tickling 76, then we came down to 75, and now we're 75.5. VIX clearly below 16. You know what? A month ago, we were at 21. So 15.5 is still not a good VIX, but it's certainly significantly better than where we were. Bitcoin, a month ago, I think we were pointing this down to like 52,000. It seemed crazy at the time. Doesn't seem that crazy now. But anyways, holy smokes. Gold treading water around 4,500, but it's not breaching above. 4,500 used to be support, but now it's resistance. And, I don't like that. And that shows that it's risk off. Oil's come down. We still would like to see this below 90. And if the geopolitical risks wane, oil can come down actually quite significantly, which is kind of interesting. And statistically, the way it's behaving is still very statistically bearish, and I can show you that later if you want. Dollar's been at 99 for a long time, so even though risk has been on and off and on and off, not very high and not very low, not very on, not very off, but up and down, dollar's been steady like crazy, just stuck at 99. And we have the 10-year at 4.5 and the 30-year at 5, and not a lot's happening there. But the concern with today, depending on non-farm payrolls, if the number's really high, so it comes out 200,000, let's say, above expectations, then some market participants are going to say, aha, the Fed is going to have to raise interest rates, maybe 1 or 2 times in the next 12 months. And we would have to reprice bonds because that's how bonds work. Bond math would dictate that the price would fall and the yield would rise. So we could see that pretty clearly by analyzing the yield curve, which we do in real time all the time. Real time all the time, right? So, and maybe if it's terrible, then a price cut comes out, but nothing right now points to a terrible non-farm payrolls, and we can get into that in a second. What I actually care about the most is actually the unemployment rate. So NFP, it's expected to be 85, was 115. So, but you know, jolts, right? 7.16. There's like 30,000 more jobs being advertised than a month ago. Like, that doesn't sound like a collapse, right? So, I don't know. We'll see. I don't think it'll come out terrible. If I had to lean one side, I would lean on higher than expected. But whatever. We don't care about guessing. $225 is high on jobless claims. Yep, that's for sure. Much higher than before. So let's just move on.com. Let's do a risk analysis. Okay, so we're looking at Bitcoin over 3 time frames, the option market on 3 time frames, volatility market on 3 time frames, 2-year yield, S&P 500, NASDAQ, Dow, Nikkei, the 210 spread, the U.S. Oil, aka WTI, the 10-year yield, gold, the German stock market, junk bonds, the dollar index, and investment grade bonds, all weighted, all over 3 time frames, and then scored for a quantitative risk analysis of all 3 times, and then the aggregate risk of all times. Okay. Brian says printing dollars, okay, and quantitative easing will anyways result in a weaker dollar. Yeah, but we don't do quantitative easing anymore. And raising interest rates won't solve the debt problem. But debt isn't why we have high inflation. And high inflation is why people would even talk about raising interest rates. The reason we have inflation primarily is the exogenous supply shock for the energy market. The war in Iran, and specifically not even the war, the Strait of Hormuz. So I would agree in that case, Brian, the Fed could go ahead and raise 1 or 2 times, but it wouldn't solve the exogenous supply shock. So it wouldn't solve it wouldn't do anything except make everything more make it harder for companies to borrow, make it more difficult for people to borrow to buy a mortgage, make it more difficult to finance a car, and then suddenly it doesn't help anybody. So really, if you want to prevent the exogenous supply shock creating a recession, you would cut interest rates. Yes, it would hurt inflation, but you'd probably be able to keep your job. So it actually doesn't, and I think you might be pointing this out, Brian, it doesn't make any sense for the Fed to raise interest rates. It doesn't make any sense. I'm not suggesting they should cut, but once again, if you want to solve the oil price issue, which goes into everything. That's why it's so systemic in our economy. You know, it's everything, energy and fuel for vehicles of all kinds, and it goes into manufacturing of all kinds of products and makeup and clothing and fertilizer. Like it basically goes across the economy. So if you want to solve that problem, produce some oil. That's pretty much it. But what we're looking at here is we're just trying to analyze what all the institutional investors are doing right now. Are they deploying capital or not? Are they bullish or are they bearish? They're slightly bullish and stalled out. It's been a flat week. It's been a flat month. It's been a flat day. The month is actually okay. But overall, we're just barely. We're a 3 out of, like, I don't know, what's the highest we've had in a while? 12. I mean, the best we've been in, in the last month is almost 7. So we're just slightly bullish. Now we've increased, but we're bullish but neutral. We're neutrally bullish. We're cautiously bullish. But then you can look at seasonality and say, well, does this create a top? Well, you'd have to anticipate the top before it happens. Otherwise, you're just another victim, an innocent bystander run over. Yeah. So what's moving right now? What's hot? What's not? Swissy is hot. Dollar is not. Which is really interesting, right? Because yesterday, dollar was strong. And I'm like, well, I don't want to buy a dollar. Now it's weak. Good. Yeah. I think yesterday, our swing trading group, we focused primarily on kitty CAD, dumping CAD. It's still strong. Not amazing. I mean, it's still weak. Not amazingly weak. Dollar got weaker, but even then, a negative 0.2 is not very weak. Swiss franc is strong, plus 0.23. That's not very strong. This whole market is basically neutral, slightly strong, slightly weak, and that tells us right away there's probably no decent trades right this second. Maybe we're waiting for non-farm payrolls. Could be a rabbit, could be. Okay. European equities doing all right, 0.65. Risk is the next bullish thing. So we are risk on by 0.25. So what did I say? We're cautiously risk on. Yeah. Well, if you look at VIX, the S&P, USD yen, the NASDAQ, the Dow, high yield bonds, and the 10-year yield, and you look at them all right now, yeah, we're just barely bullish. Now, why did I pick those assets? Well, actually, we look at dozens and dozens of assets, and we correlate them using the Pearson correlation coefficient calculations of the 72 assets relative to risk. Every hour, over the last 90 days and then look at the relationship between risk and those assets and dynamically create baskets based on um, direct or inverse, right? Positively correlated or inversely correlated data. So like if it's risky right now, we want to trade things that do well in risk. But we also want to know things that do the worst during risk and then point that out to say, well, that relationship tells us how the market reviews current market conditions right this second. So it's only, 1,000 calculations every few minutes to say, hey, right now, when you look at everything in the entire world, we're slightly risk on, just barely. Right now, just today. Now that it may be different over a medium term, like the last 7 days. It may be different on a longer term, like 30 days. But we're going into NFP and I'm like, well, it's slightly risk on. Like we're not freaking out, but nobody's getting excited either. So should you be a loose cannon, a wildcat out there throw down trades, right? No. You want to try to align yourself with the institutional investors. And we can see that nothing's happening right now. So you're out there on the ice floes by yourself, swimming with the killer whales and the bears, the polar bears. Energy, a little bit negative. Metals, about the same. Asian equities and crypto, massively bearish. Crypto is a dog with fleas. Okay, so if you're doing anything, okay, what's the best currency trade in the world? USD, Swiss franc, short. But that's mediocre compared to just trading Bitcoin, Ripple, Ethereum, etc., etc., etc. Cool. So you're like, well, how do you put that into a trade? Well, you can look at it this way. Okay. Pound dollar up. Right now, we're looking at a 0.31. Very low conviction. USD Swiss franc to the downside, which we already covered, and very weak conviction. But Bitcoin, high conviction. It's a dog. Dollar slightly strong. Bitcoin is terribly weak. Down to down to down, down, down. So of all the Forex stuff, there's no real amazing trade. Look at all the trades all have scores, conviction scores of 1. And we drop very quickly. Bitcoin, definitely dump it. Silver, yeah, medium conviction. And then we get down to DAX and we're like, nah. Maybe up on DAX. Okay. It's cool. So there's really, looking at all the assets on the planet, you should probably be sitting on your hands right now. Hang on a second. Hang on. I got a little side action going over here. All right. It's been a long Black Day. All right. Cool. Now, I like to organize this way. And yeah, Bitcoin, silver. Yep. And then I'd say, yeah, not good enough, 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 not good enough. I don't even need to look at the charts. Why do I care? Why would I care about this? Don't even look at the chart. Doesn't matter. These are based on charts. They're just quantitatively mediocre at best. I mean, we're definitely bullish and we're definitely bearish, but based on our quantitative analysis, it ain't likely to go anywhere until non-farm payrolls. Okay, so what I care about the most is the unemployment rate, even though NFP is sexier. As far as macroeconomics is concerned, it's not a good idea to compare the number of jobs added in the United States to the number of jobs added in Canada to the number of jobs added in the UK to the number of jobs added in Australia, number of jobs added in New Zealand, because well, we need to know per capita. 15,000 jobs is nothing in the United States, but if you lived on a tiny island, that might be huge, right? So it's all relative. So how do you do it per capita? And you do it as a percentage of the workforce. Oh, so NFP is sexy. I care about the unemployment rate because I am going to compare the United States to Canada, to Great Britain, to Europe, Switzerland, to Australia, so on and so forth, right? Shout out to New Zealand, right? So, we care about these things as macroeconomists. So that's what we use really for our data analysis. But we're going to be watching this come out in real time, 19 minutes. There's our history. Gorgeous. Slightly risk on still. Oh yeah, we're trying here. We're trying to move. Okay, we're trying to wake up. Definitely a downtrend in play, don't you think? We're at the threes and then the twos. Then we kind of went ugly for a little bit and then bounced back. Remember jolts? I guess we should do that now. Let's jump to the fundamental section. First of all, later today, especially after NFP, we can watch changes in the interest rate. So this is us analyzing the implied Fed funds rate a year into the future. Yeah, we can do this. And I can even tell you the probability of the Fed raising or pausing or cutting, because we can do it mathematically. And we can do this at TradeRs for every central bank in the world. If you want to know the chance of Canada raising interest rates, cutting interest rates, and when, we can grab that data. There's not a problem for us. And remember, it's not guessing, it's not fuzzy logic, it's not AI lying to us. We're using pure mathematics, and I can explain all of that, but it's in the price. We track GDP and all the subcomponents of GDP. And just, more than just charts, by the way. So we have all this stuff, right? We can track all this stuff. Durable goods, business inventories, industrial production. It all goes in to different parts of GDP. So imagine you could just have a database and it has all these numbers in it, and then you store all the history of these numbers, and then you just put it up there. Because we're AI and we're doing relational mathematics, This is not a data dump. We don't just host a bunch of data. There's sites out there that have all that. That's not what we do. So when we pull data from government government databases, so we're plugged, we don't like scrape it off their website. We're plugged in to directly inside the government agency databases, and we get it directly from the government agency, right? But when we pull in, it doesn't just dump it into a big database and say, here's all the GDPs, and here's all the PMIs, and here's all the durable goods. It's actually logically using AI organizes the data in with the intent of using the data to make calculations. So we pull it into a decision-making framework. From the beginning, we organize it and say, okay, this piece goes here, this piece goes over there, this piece goes over there, all based on a decision tree of what does this mean for investing and trading. That's just our intake of the data is designed as a decision tree, which I made, by the way. Yeah, wicked smart. Yeah, and then because we know we need the data to analyze and see relationships between the economics, the news flow that's coming in, the real-time pricing that we have for, on all these different time frames. So we see 72 assets in real time, but we track them on 3 time frames, and then we have 20 years of that data, and then we're watching all these relationships. And so anyways, it's really, 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 really awesome, beautiful, and sophisticated process. Okay, not a data dump, more of a neural network built specifically for trading and investing. Yeah, it's really cool. So anyway, so we got GDP and all that we track in great detail. Okay, we have different measures of inflation, which is nice, and we can go through all those. But today, we can go through jobs. Later, you might want to look at gold and oil if you want. And we're in process of building a global PMI analytics page as well. So how do you feel about non-farm payrolls? Well, here's the history. We can go back in time, and it's been a little ugly, and we seem to have stabilized, and we are predicting sort of a humble dip. Okay, maybe as low as 77, and then a recovery from there. So this is actually saying a lower number, lower than the consensus and the worry about a hot number. But, it's only looking backwards in this case. There's nothing complicated going on in this analytics, but we do shape it for the history of how NFP performs throughout the year and some other things to predict the dotted red line. So this is non-farm payrolls in the future. Isn't that cool? I know, right? Then we have our weekly claims. Pretty steady, although we have it rising here, and it has been rising. So we have it rising, okay, a little. The unemployment rate has been very, very, very stable. So there's, we don't have a change in the next several months going out all the way out, to July, which is August, right? August, we get the July numbers. And even then, no change in the unemployment rate. So that doesn't seem statistically like the economy's collapsing. Average hourly earnings, they were too high before, and that was part of our inflation problem. So this is projected to continue to improve slightly, which is fine. There's no collapse or anything. JOLTS actually improved. So we got back over 7 million I think it was 7,160,000 jobs being at open positions being advertised. ADP, yeah, we were just, kind of just, Nothing says panic. Participation rate. Okay, all the ratios. So everything here is okay. But maybe a drop down to 77, but unemployment rate stays the same. Okay, how much time do we have left? 10 minutes. Cool. Now, all right, so we can come back. We'll get ready. But anybody like gold? Anybody like oil? Let me show you oil first. Now, this page will get updated later today based on the rig count this afternoon. And also our commitment of traders report gets updated this afternoon as well. So you may want to go look at the COT. But specifically oil, we're back to 93. Okay. Inventories are falling. Okay, that's how much oil is in storage in the United States. Global GDP is falling. That's part of our demand side. So when it comes to a commodity, well, really everything, but specifically in a commodity, you have the supply side equation and the demand side. And what we need to do is both. So we're looking at production. It's stable, but inventories are low. So that means oil would be on the higher level. Well, 93 is on the higher level. We're adding rigs in the United States. We added 4 week over week. Canada's got 162 going, but look at Kenyatta adding 24. They're like, hey, we're not in the playoffs. Hey, we're not in the Stanley Cup. Get back to work. Go produce some oil. You got nothing better to do. Yeah, you're not going to play hockey. Drill some oil. Yeah. Hey, Dan, you got a hot mic. I got it. There you go. All right. So, anywho, now look at this prediction from 93 to 45. Holy smokes. Well, whoa. I know you have a ton of questions, right? But let me remind you that at the beginning of the year, we were at $62 a barrel, and we were predicting 92 by July. We're almost to July and we're at 93. Like, come on, bro. But that's not really what we're doing here. We do this, we can do that prediction in other places too. But what this is doing is simply statistical calculation. So based on what its data set, which is probably from May to now, it's been bearish. That's all it's telling you. And if it continues to be bearish at this rate of change to the downside, then by the time we get to September, we'll be down to the $50 area. That's all it's saying. It's not predicting anything. It's just showing you the trend that exists now. That is the trend. Mathematically, well, statistically, that is the trend. Okay, and then we're trying to figure out demand through using GDP, and we're actually using GDP predictions from various groups, EIA, OPEC, the World Economic Outlook by the IMF, right? And so we're trying to figure out, is demand going to increase, decrease, or is it fairly stable? And remember, stable means increasing in a weird way, but that'll show you the demand. So like, for example, if demand is steady but supply falls, price will go up. So we got two moving curves here, supply and demand. Okay. We need to know what's normal for inventory and where we fit in that. So this is the standard deviation of oil inventories going back over 5 years and then creating a seasonal price action, if you will, or no, I guess it's not price action, but a seasonality shape to the year. Okay, that's what we're doing here. And this still needs some improvement, but right now we're 15 million barrels lower than normal for this week of the year. Nasty. That's cool, right? You're like, wait, 15 million barrels lower than the 5-year average for this week of the year? Uh-huh. So it's on the low side of the standardized deviation. Cool. And you can see that whole shape in advance. It's kind of nice. Real nice. But if you like gold, we're working on gold here as well. We have gold coming down for sure based on what has been happening. But we have it stabilizing and then turning north soon, or not soon, sorry, at the last half of the year. And this bending and contortion is based on seasonality and a whole bunch of other things. So this is much more predictive, where this is more analysis of the trend. It doesn't mean we're going to 3,400. It means based on how the gold price is behaving right now, recently, if that continues, that's where we end up. So really what we care about is, what if we double bottom here and then it starts to turn north? Then this number will start rising again, and it would confirm, if you were a bull, that that has held, and now you have the linear projection in the direction that you're going. So it's not a prediction at all, where to the right, it totally is a prediction. Okay, gold futures, we look at how much gold is in the vault and the change in the how much gold is in the vault by large institutional investors that hold gold positions so big that they're required by law to report it to the government. We track it week over week, so you can see they've actually been selling some gold. They've been long gold for a while. They sold some in January, held tight, and maybe they're selling again. So that's right, institutional positioning. This is the production side of gold. Now, I can't get you pure gold, but I'm separating copper and iron ore and all that kind of stuff. Based on the government database, the best I can get is gold and silver ore. A gold mine probably produces silver along with it, right? Like you, so we track the activity. Okay. And, so we have supply. We have the purchases and sale of gold by central banks. This is trickier to get, but we have it. And all kinds of things. Who's buying? ETFs may be buying or selling. Tech companies might need gold for their data centers, jewelers, which is kind of neat because we can start tracking. If the economy is good, do we buy gold jewelry? If the economy is bad, do we not? Be interesting to start tracking that, have some high frequency data. Okay. And on this page, we also calculate the real yield to see if there's a relationship between the real yield and gold. This is just something I'm playing around with. We have a gold silver ratio. So you should probably be trading silver over gold. Oh, we got to go.
Spike alert, 90 seconds until United States unemployment rate is released.
Wow. All right. Thank you for the heads up. One minute to go. You guys excited? I'm giddy. Let's celebrate with some confetti. Whee! Yeah, baby. Yeah. Okay. Let me turn the squawk on.
US dollar. Structural headwinds seen after recent strength. Nordea. European Central Bank. June hike starts recalibration phase.
12
Nomura.
seconds.
The US dollar is lower ahead of the US jobs report. What are the technicals telling traders?
United States unemployment rate, actual 4.3% met forecast.
Cool.
Bay Street may open on weak note. Canadian U.S. jobs data in focus.
So we had that one.
Oil. Inventory declines tighten outlook. ING.
Mexico consumer confidence declined to 43.1 in May from previous 44.3.
Mexico consumer confidence SAA 43.5. May versus previous 44.4.
Euro picks up. US dollar loses ground ahead of US non-farm payrolls figures.
Cool. So
United States unemployment rate meets expectations 4.3% in May.
United States U6 underemployment rate rose from previous 8% to 52% in May.
India GDP growth accelerates.
cool. So no, like I said, the headline up, down, sideways is one thing, but really as longer term traders, investors, concerns about the value of the dollar, concerns about debt, concerns about Fed policy, we really care about the unemployment rate. We have it predicted going out almost a year without a change. And so that's what we got this morning. Nice.
Breaking, U.S. non-farm payrolls rise by 172K in May versus 85K expected.
So it's
Canada
a good number.
employment change, 87.8K versus 10.0 estimate. The unemployment rate falls to 6.6%.
U.S. May non-farm payrolls plus 72K versus plus 85K expected.
So remember what we discussed. A high number is going to lead some to believe or conclude that the Fed must raise interest rates. And that is actually bad news. The good news is bad news based on behavioral finance. Now, this is what you're going to hear on TV a lot. And it's really, as I discussed before, based on Brian's comments, probably not actually true.
United States U6 underemployment rate up to 8.1% in May from previous 8%.
So we can track the yield curve to see if that's truly how large institutional investors are trading. Do they think, does the smart money think the Fed's going to raise interest rates? Because they have to invest billions, if not trillions of dollars, and they do very serious calculations. They're not dumb. They make mistakes, but they're not dumb. And there's this real risk that those that are being the talking heads on TV, they're saying high inflation, Fed has to raise, and that's Cambridge Community College economics and monetary policy, not Harvard. Because we would look at it and say, well, okay, yes, we have high inflation, but what solution does high interest rates provide to that equation? All you would do is spike your unemployment. That's the likely outcome. And I can't imagine the Fed sitting around going, well, we have high inflation. Why don't we also have high unemployment too? Now, look, maybe they can make a mistake like that. You better pray that they don't. But I don't think they wake up and say, let's have failure on both dual mandates. Let's have high inflation and rising unemployment. No, we call that stagflation. And so, if anything, and what we have mathematically is we're on hold for a while. And what we want to watch over time is that analysis changing. And we can get, okay, nobody cares about opinions. What we care about is the money being invested by institutional investors. They're voting with their money. So we're at 3.75. A cut gets us to 3.5. A hike gets us to 4. Okay. And we're right 3.75 now, 3.63, 3.65, 3.70, 3.71, 3.79. So that's all the way out to December. And we're essentially the same interest rate. Now remember, okay, we're looking at millions of financial contracts being negotiated between banks and large institutional investors. And from that, we get the price. We can derive the price mathematically. And the price then derives what the yield is. So it's not one contract, it's millions, hundreds of thousands, right? Worth billions and trillions of dollars. And so we look at it, and what's the average yield by derived yield by looking at all the prices. Okay. That's why it's not specifically 3.75. Well, some were lower, some were higher, but we're calculating this in, and it's essentially the same all the way out to the end of the year. So what I want to watch now is how this changes over the next few days or even today based on non-farm payrolls, because the value of those bonds will probably fall. The price will fall, which would raise the yield. So we can capture the price falling and derive the interest rate. And right now, the December is at 3.75. 3.79. It's currently 3.75. So there's no Fed hike. Remember, you got to get it to 4 to be a 1 hike. January, 3.8. March next year, 3.88. May 2027. There's a Fed meeting on the 5th of May. Maybe. Because we're not at 4, but we're getting pretty close. There's a lot of people pricing in 4 when we get to sort of March, May, June. Okay. And then these are so freshly cut treasuries, we don't have enough data. But we never right now get to 4. We get close to 4, but we definitely don't get to 4, meaning at best right now, analyzing all this data, maybe 1 hike, and maybe 1 hike in the next 12 months. Forget about this year, 12 months, maybe. And we get pretty close, so you could even say probably. So that December 8th, suddenly it pops up to a, right? We get to a 31% chance of a definite maybe. That's what it looks like. Cool. And this is for those that are trying to do carry trades. What do you think? Aussie Swissy, Norway Swissy, USD Swissy, Pound Swissy. Those are your best carry trades right now on the G7. I trade Rand and Mexican peso as well. Yeah. Cool, huh? Yeah. So let's take a look and see what prices are doing. So we also had the CAD jobs report. Look at the comeback kid. CAD went from weak to strong, but not very. Kiwi is weak, but not very. If anything, like, yes, some went from slightly, so CAD went from sort of slightly weak to slightly strong. If anything, the entire Forex market just tightened. What do you think? Is that good to know? Very good to know. And oh my God, is that right? Guess so, yeah. Nothing to trade. No Forex trades at all right now. Now, you might be on a chart and you're like, yeah, look at this thing, Wayne. I want to buy it so bad. Well, statistically, it's not likely to work out the way you think it's going to work out. There's no volume. There's no volatility. There's no differentials. So each one of these, like pound Kiwi, to get this score requires 15 calculations. There's no way you're looking at 15 charts just to decide whatever you're staring at now. And you're like, it looks good, Wayne. I want to buy it. There's no way you're looking at 15 different or 14 different charts and then doing the final calculation. Yeah. So just amazing. We've never seen this before. You'd have to go out to swing trading. Yeah, higher time frames. Yeah, but right this second, hold your horses. That's what it says. Actually, I just want to jump there.
Spike alert, 90 seconds until United States unemployment rate is released.
Sorry.
United States unemployment rate,
United
States unemployment rate, actual 4.3% met forecast.
Sorry, I logged in to the back end. Okay, we're very flat. Ethereum and Bitcoin taking a nosedive. One thing I forgot to point out yesterday is we are building. Wait, did that filter politics? I guess so. We are building data on prediction markets for politics. I want to get towards building something for us to track the midterm elections, but right now, Colombian presidential election. So like Maine Democratic Senate primary, I'll get rid of that. I don't want to go there. Okay, this should leave. That should be deleted. Presidential 2028. JD Vance. Look at that. That's interesting. It's not for 886 days, though. Colombian presidential elections. Okay. Democrat presidential nominee in 2028, Gavin Newsom. The next French presidential election winner. %70 chance the U.S. announces a ceasefire deal by the end of July. Peruvian elections. Quebec general election. Again, I don't need state or provincial. So it's not quite what I want, but we're pulling the data. And so this data shows us how money is actually being placed on this data versus an opinion. It's opinions backed by money. But we care mostly about things like a 98% chance the ECB is going to raise interest rates at the June meeting in 6 days. 99% chance the Bank of Canada keeps things the same at their meeting in 5 days. The Fed meeting in June, 99% no change. RBA decision in June. It's 11 days from now. 97% chance no change. So it's interesting, right? And they're not just opinions. We're not doing math here. We're tracking people putting money on that opinion. So it's a pay to poll. Pay to poll. So like a Fed rate hike by the October meeting, well, we know there's a decent chance of a hike at the October meeting. There's right. And that's what the market is telling us right now. So 77% chance, no change, 75% there's a hike. And that's okay. I get it. Someone's done the math. We just did the math earlier today. Probably not. That's what the market says. But very well could. That's what the market says. Remember, one, we're doing the decision ourselves. Now, if we put money on that, then it would get counted here. So we already see the October bets being put down. And because we studied changes in the yield curve, we can see that this is a reasonable assumption. So we understand how they made that decision. They were informed. It's cool. It's cool. And as you can see, it updates every few minutes. Okay. We like to track Mexican GDP because you got to know this stuff. So we're still working on it. We're getting there. It's got potential, I think. Copper, nat gas, Nikkei, all looking good. USD, Swiss franc. Okay, now most of this data is fundamental. So I consider these fundamental scores. Some of the score is technical. It is based on charts. So when you go to table view, okay, trend and momentum are measures of velocity, we'll say, and direction of the charts. The index is then saying for pound yen, let's look at the Great British Pound versus all other currencies. And then let's look at the yen versus all other currencies. Score them, and then compare the two for an index score. And since it's price action, you can consider it kind of charts. It's all price based. We're not looking at, the job market and comparing them, the job market in Great Britain versus the job market in Japan, and see who's the better, economy. We're not doing that. We're just looking at, we're creating indexes of each currency and then comparative analysis of the two indices. Cool. And we're working on something. He doesn't quite understand what I'm doing, but we're getting there. We'll play around with it. It's pretty. It's not what I want. And what I want, I guess, is very difficult for me to describe because it's a bit complicated. And so this is my lack of ability to explain to AI to do the analysis and produce the output the way that I want. Because Really, I guess it's okay. Look, copper, USD, Swiss franc. So it's basically doing this page. Okay, copper's the best, then USD, Swiss franc, then nat gas. Okay, that's a 5.18. Then Nikkei, then pound yen, then pound kiwi, then kiwi Swiss franc. You see, and so you're like, hey, this is cool, but can you just put it in order? So, but this is not what I intended. That's not where I'm going. We can get a little more clever than that. And also, it doesn't fit very well on this page, right? But so copper, USD, Swiss franc, okay, nat gas. See, we just did it ourselves. Nikkei, cool. So I think it's got potential. It's just not there yet. But these are the things you should be trading. And if you're trading gold right now, you're not analyzing the market properly. You're just grasping at straws. Okay. So USD Swiss franc, bro. I wonder if we need to go through any of this today. Didn't think so. So somewhere around June and July, which is kind of now, the S&P 500 peaks. Can you see that? And then you get to August, September, and there are declines. Thing is, maybe it happens earlier this year. Could be. Maybe it's a slow melt up. Maybe, but we have a Fed meeting and then it's summer. And traditionally, volume falls. Traders and investors are more likely to take profit on trades and then jump on their yacht and sail Sardinia and not trade anymore until they come back. That's the more likely outcome. In America, people like to do things in July. In Europe, they take the whole month off of August. The whole month of August. The whole month of August. What do you guys do over there? Yeah. So we can expect at least a fizzle or a fade. Yeah. So I want to watch this throughout the day. And on Monday, you guys should log in and see if this goes above 5.0, if this goes above 4.5. It's important because we're trying to analyze how the bond market has interpreted this high number on non-farm payrolls? Do they believe the Fed is going to raise interest rates? And we can calculate that by looking at this. Now, we need them to change their prices. If they do, we can decide, well, what was their opinion? A hike or no hike? And if you don't know how to analyze this, don't worry, we have artificial intelligence. Okay, risk on, rate hike. That's what this says. Did you know that? I'm telling you, you never have to listen to a talking head on TV or a babble-faced knucklehead on YouTube. You have the data. It's right in front of you now. And the interesting thing is I'm showing you multiple different ways to get to the same decision, because not everyone uses the same decision tree. So we can look at it this way, we can look at it that way, because they look at it this way, they look at it that way, but they're all making the same decision. Do we buy or do we hold? Do we accumulate or do we distribute? And we can track what they're doing. You don't have to be a retail trader anymore. Sure, you only have $5,000 in your account, but it doesn't mean you have to make dumb decisions. So you should see what the big institutions are doing and trade along with them. And there's no work now. Later today, we have the Commitment of Traders report. And this is a big deal for us because this is another way to track both positioning and flow, right? Cash flow, you know, the movement of money. So we'll get an update on that, but I'll give you an example here. Institutional investors are long gold. There is gold in the vault. We can tell you how much. Literally the number of contracts. We can tell you how much gold is in the institutional investor vaults. What we also care about, so let's just assume long-term long. But what's very interesting is, what did they do this week? Did they buy more gold or did they sell some of the gold in the vault? They sold some. Oh. Why aren't they buying it? If prices are falling, isn't that a better deal? They're not buying. That's why it's falling. They're selling. Yeah. So this gets updated later today. Okay. One of the things we talked about last week. Yeah, well, profit taking for sure, right? Because they're not short, they're long, but they're less long. Yeah, for sure. Or they got to pay for losses somewhere else. So you got to sell your winners to pay for your losers. But another thing that I've been watching, and we made a big deal about this last week, is that institutional investors are long the Aussie dollar, but not week over week. They're actually selling a little bit, not dramatic. But what happens, in scenarios like when does it predict a top or a bottom, I guess is what I'm trying to get to, right? So here's another example. Even though the market is net long Australian dollar, they are short the Kiwi. But there was some buying activity week over week. When does this become a short squeeze? Because that's a fair amount of buying. In fact, it's pretty much the only currency that got bought. in a down market. Now, having watched price action all week, we didn't see more accumulation of the New Zealand dollar. So we haven't seen a short squeeze because, well, Kiwi's been short. Kiwi's been doing this, just as you would expect. Brian was talking about weak dollar. Yeah, well, institutional investors are short. It's a fact. And they got more short. Okay. So we break it down here. Okay. Aussie dollar is the best setup based on the commitment of traders report. Only. No fundamentals, no technicals. Just let all the institutions decide that. Okay. Aussie dollar long. Half as good. No, wait, we got to do this one. Aussie versus Kiwi long. Institutions are heavily long Australian dollar, heavily short Kiwi dollar. Okay. Pound dollar is slightly better than the Aussie Kiwi. So I'd probably go there, right? Aussie dollar, pound dollar. What about Aussie yen? Well, the differential is 36. This one's 39. We'll call it 40. So best opportunity, second best opportunity, third best opportunity by analyzing institutional positioning. Now, the cool part of this is, what if pound dollar was down this week and Aussie yen was down this week? What we're trying to do is be able to buy a dip in the direction that institutional investors are buying, and then stay with them for longer periods of time, like months. Okay. So not a trade for 15 minutes, a trade to the end of the year kind of thing. And then you can then say, well, what's the shape of that trade by looking at seasonality? So you could say, all right, you're interested, Aussie yen long. How does that do this time of year? Because remember, all we're analyzing is institutional positioning. So Aussie yen long, does it make any sense? And you got until July 1st, and that'll fade on us, and then you buy it back on September 1st. Okay. Now it's not really the first and the first. They're turning points. So somewhere around July 1st, you take profit on that Aussie yen long, and then somewhere around September 1st. Now, typically for me, it's the third week of September. And we have that kind of look at it monthly. Okay. So look, check that out, huh? So somewhere, right? Somewhere in the June-July period, it flips. So in June, it goes up 2%, 80% of the year, right? Over the last 5 years, 4 out of 5 years, June was positive for Aussie yen. Okay. Vol between 1 and 3. June typically rises for yen plus 2.16% with an 80% historical bullish success rate. Historical data for Aussie yen does not show a strong recovery pattern in July after July's average return is down. Well, like I said, we saw that somewhere around that July area, a little bit before, a little bit after, it tops out and then goes from bullish to bearish. But we already know this. We also know it continues into August, and somewhere in the September period, it then reverses from bearish to bullish again. And like I said, I don't think I can prove it right this second, but maybe I can. I like to consider it around the third week of September. Okay. Worst 3-month streak of the year, July to September. Dude, you don't know this? Dude, it's spelled out in the English language. If you don't like charts, okay. Best 3-month streak, February to April. Did you miss it? Weakest month, August. Do you want to be long Aussie yen in August? Most reliable month, 75% of the time, it goes up every time. Best buy the dip month, June. Hey, is it June now? Yeah. I mean, come on. You're like, Wayne, this is gobbledygoo. How do you track this? Okay. Well, we have average returns. But if we go to the seasonal charts, we track the 5-year average, weekly organized by monthly, the 10-year average, weekly organized monthly, 20-year average, weekly organized monthly, and then the 20-year exponential moving average of the weekly organized monthly. And then from that, we can create aggregates and medians and means and modes and calculate standard deviation. So I show you when you click on things, you see the standard deviation of all these periods, and we've plotted them out here as well. You can see the likely moves, the shorter term, the longer term, and then the gray. Can you see the gray bars in the background? It shows the largest of the deviations over the period. How much volatility is in there? Is it? You're like, well, most of the time it moves 2%, but sometimes it's 7%. You're like, whoa. Yeah. So you can say, well, maybe that goes along with your aggression level. You're more aggressive in the months that are strong months, but have also shown great months. A little less fear, a little more greed. Yeah. Yeah. So 20 years of weekly data organized by month and helps you shape the yield curve. So you can make money in July or June, but you should probably get out in July and then buy it back in September. And then what? Yeah, you can stay long. So let's say you buy in this dip. Red doesn't mean sell. You should sell at the top. And it continues to fall. So somewhere in here, and then the drop. And then you can buy a November dip, probably around the election, and hold it what? December's a flat month. January is an up month. February is an up month. March is an up month. Look at this. You hold all the way to July. Wait, you mean buy in November and get out in June? Yeah. You're like, wait, that's like a 6-month trade. It'll probably work. Remember, these are 20 years worth of data. So go back into June. So imagine, or go back to the beginning of the year. Imagine you bought right before the end of the year this Aussie yen. Why? Because that's what 20 years of data says, right? We just saw that you can buy that dip if you wanted. And how long do you hold it? Well, you hold it till July. So you'd be all the way up here now. Okay. 105. Now we're at 114. So that's 1,000 pips. Good enough? It's showing you direction. It's showing you probability. It's showing you volatility, projections, of course. But 20 years is a lot of data to have, isn't it? And you can do this for everything. Yeah. USD Swiss franc is way different. So we show a normal sort of peak in the first quarter and a drop in the second quarter. Then a little up and then a little down at the end of the year. So we already have it plotted out for you. Neat, huh? Well, you can also see it's pretty sideways. A range of 200 pips down, 200 pips up. That's nothing compared to the Aussie yen just moved 1,000 pips in the first 6 months of this year. Well, it's reserve currency versus reserve currency. Yeah. Cool. So anyways, seasonality you should play with. COT, this gets updated today. Just like the rig count gets updated today for the oil page, the oil analytics I showed you. This will get updated today. So over the weekend, you should review it and pay attention to see the changes in flow. Now, when we looked earlier, it said, don't do anything. Yeah, it's tough because you want to do stuff. So what do we see here? Dollar strength. Dollar strength. CAD strength? Well, remember, CAD had its own news. Crypto was super weak. Doesn't look like it changed. But I want to go further out and do some swing analysis. So yeah, sure, some NFP volatility, but I don't have any meat on these bones. We saw that immediately. Things are moving kind of. Dollar got strong, but not that strong. I'm old, but I'm not that bold. Is that Pitbull or is that One Republic? I think that might be One Republic. Further out, what do we think? Okay. But again, I don't like when you look at the seasonality, we know USD Swiss franc is very, very, very sideways. Now, maybe you catch a nice little carry trade on it. I don't mind moving sideways if I'm earning a carry. So it's kind of like a bond, not much volatility, but you clip a coupon, right? USD Kitty Cat. The swing is, we're not in a beautiful trend yet. But if we make a higher high, we could. We have a fresh 2155 cross. Projections heading out. should hit the monthly target, but we might already be focusing on the July pivots, but anyways, it'd be interesting if we can get through MR2 and go to MR3, which is kind of what we're looking at. Best case scenario here is 140 and beyond. So 160 pips is projected. We will have to breach MR2, monthly R2. In that case, you would target monthly R3. I don't know what it is, but using linear projections, I wouldn't be shocked if it's somewhere around 140 and a half. Cool. Good. Yeah. What time is it? Yeah. Well, that'll be interesting. NASI, very interesting here. But on the 4-hour point of view, it's still got a lot of upside potential. Mm-hmm. Yeah. Cool. Well, I think what we'll do is we'll just go back to the squawk box.
United States U6 underemployment rate up to 8.1% in May from previous 8%. Breaking, U.S. non-farm payrolls rise by 172K in May versus 85K expected. Canada employment change 87.8K versus 10.0 estimate. The unemployment rate falls to 6.6%.
United States unemployment rate meets expectations, 4.3% in May.
United States U6 underemployment rate rose from previous 8% to 52% in May.
U.S. May non-farm payrolls plus 172K versus plus 85K expected.
U.S. dollar. Structural headwinds see strength. Nordea.
India GDP growth accelerates.
Aluminium. U.S. supply strain risks demand destruction. Commerzbank.
160 Augur, U.S. dollar yen back near intervention territory after upbeat U.S. jobs report. Euro falls against pound after Eurozone GDP data paints weaker growth picture. U.S. dollar yen climbs above 160 the plunges as non-farm payrolls crushes expectations.
U.S. stocks may move to the downside in early trading. Sterling today, pound slips as strong U.S. payrolls boost dollar. Goldman lifts copper prices view on ex-U.S. market tightness.
Indian rupee, RBI holds but defends INR, BNY.
Yeah, so what are we, about eight minutes to the stock market open? So look at Sol. Oh my God. Look at Bitcoin. Ugh. So FTSE up, Dow up, DAX up. Ethereum down, silver down, Hong Kong down, Bitcoin down, copper down. Dismal. Yeah, and USD yen above 160, you probably know that that's intervention watch, but I believe if oil is clearly below 100, I think what I said was above 105 and 160 on USD yen, then intervention watch. So now we're above 60, but oil is clearly below 105, clearly below 100. So maybe no need to intervene. Moshe wants some Bitcoin. Anybody trading crypto? I'm old, but I'm not that old. Bold. I'm not that something. Yeah, we could look at crypto. Which way do we want to analyze this sucker? La 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 la. Bitcoin. Okay, Bitcoin projected down. COT negative, seasonality negative. So for example, what does this mean? Bitcoin usually falls this time of year. The trend is negative, the momentum is negative, the macro is negative. Positioning is short by institutions, but long by retail. Oh. Okay. 60.3, and then we stabilize, and then the third week of September we rally. What do you think of that? Abdul says, read an article that it's going to be 40K. All right. This is not my opinion. This is statistical analysis of quantitative data. And sure, that's possible. But okay. So one point, at some point, people will say, "Oh my God, it's falling. Therefore, something is wrong, and it's going to collapse. Even though it was 120, it's going to drop to 40." And they're freaking out because it's dropped significantly. Does it change your point of view if you knew that June was almost certainly, or let's say a definite probable down month? So if you look at Bitcoin over the last 5 Junes, it falls 9%. Okay. Yeah. Massive volatility, typically ending up in a loss. Okay. So we don't know what's going to happen in June, but we know it's probably going to be bearish. So now you read an article and they're like, oh my God, it's going to drop all the way to 40. Yeah, it could for sure. I don't know the future. But when you look at history, if you buy the dip somewhere in the abysmal June and hold all the way through July, 80% of the time, it went up significantly. Historic data shows Bitcoin typically recovers in July after June weakness with an average improvement of 17.5 percentage points. So we take this into account and say, okay, well, June is down, but duh. Like if you don't know that, then you can't trade, right? Like if you didn't know that was happening, you probably made a lot of mistakes. And maybe like, look, if you're honest with yourself, you should be kicking yourself. If you didn't know this, you didn't roll into June knowing it's a down month, then what kind of analysis do you do? And then now if you're in pure panic mode, oh my God, we're going to drop from 60 to 40, you can say, well, that is possible. But based on the way Bitcoin has behaved, it's not probable. I wouldn't say that they would be probably right. I would say I have enough data to say, well, we're probably going to double bottom. And then tread water till the third week of September. Oh. Ow. But not based on macro, not based on geopolitics, not based on what Trump said or didn't say, just based on historic analysis. Now, past performance does not predict future results, but there are patterns in the chaos. So Abdul says, hey, I read an article that says Bitcoin is going to be at 40,000. Okay, I haven't read the article, but they're probably not right. But you don't need a license or an education to write an article, do you? Cool. I'm bold, but I'm not that bold. Jim wants some ETH. Okay, not a problem. Different numbers, of course, but not a problem. Okay, best time to buy Ethereum, probably at the end of February. or actually in February. 70% of the time, Ethereum goes up in February and then continues March to May. Damn. Worst month for Ethereum out of the entire year, June. So this is what I'm saying, like, if you don't know the basic facts, I love trading bloodbath. I think so. Like yesterday, we were talking about bias can be a weakness. I think Ethereum's going to go up forever. I think Bitcoin's going to go to 1 million. Okay, that's not a good bias. But you can use bias as a confirmation of reality and improve your trading by turning a weakness, bias is a weakness, into a strength. Bias can be preparation. It's just how do you set your bias? So in this case, you could in May say, I'm worried that crypto is going to fall in June. I have data that shows it's probable. Crypto will probably fall in June. But May, it's up. Okay. So what if somewhere in the second half of May or the first half of June, crypto rolls over and goes from bullish to bearish? Do you believe it? Are you prepared for it? Do you even recognize it? And that's the thing. Most of us don't recognize a reversal until it's too late. It's already reversed. But if you saw a double top, how do you know if it's going to go make a higher high or reverse and fall? Well, if 80% of the time it falls, dude, be open-minded. The double top's going to hold and the sucker's going to drop. You're prepared. But the thing is, it's not just preparation. It's that you recognize it through your bias. You're like, oh, here's a top right on schedule, versus someone else going, well, Bitcoin's going to go to 1 million. So yeah, it's definitely going to break. Well, dude, that's not analysis. Hope is not a strategy. Okay. Analytics increases your probability. It's like counting cards. You're tracking what institutional investors are doing. It's like ethical, legal insider trading. Okay? You're trading and investing with institutional investors. And we can track how because that's all this stuff is. So why is June a bad month? Dude, people are taking profit and going on holidays. It's just, that's basic. It's human activity. They're like, they're not going to trade crypto on the yacht. They're done. Or maybe it has to do with the way that crypto ETFs work. Okay. Do you think some of these ETFs are taking profit so they can issue a quarterly report and issue their dividends? You're like, wait, it falls just because of the mechanisms of which you need to run an ETF? Yeah. Yeah, we're almost done the first half of the year. People are going to go on vacation. They're like, you know what? I'm not going to sit on my Ethereum or my Bitcoin that, you can wake up one day and it could be negative 30. It's terrifying. You convert that to cash, and then you put on your Queen swim trunks and go on vacation with your cash, not your Bitcoin. Bye-bye. Love you. My beautiful wife on the vacay. So, yeah, so this human activity does matter. It matters a lot in commodities. When does the price of oil go up? Well, you just need to know the supply and demand of oil. What's normal? To know that, you need to know the supply and demand of the products that they make. Because nobody buys WTI and Brent except oil refineries. So if you don't understand the oil refinery business, you don't understand oil. Okay. So like, let's actually talk about that. Because this goes into part of Aiden's assumptions, right? Why is Aiden predicting down? He's not predicting 45, like I explained earlier. But why down? Well, oil refineries have already bought enough oil. They've already made the product that they intend to sell. They buy WTI and crack it and put it through your heater treater and then through your vertical separator. And right, then they take that and crack it into whatever they need. And the end result is a product. Maybe it's fertilizer. Maybe it's tar or bitumen. Maybe it's jet fuel. Maybe it's plastics. Maybe it's lubricant. Maybe it's diesel. Maybe it's gasoline. So they bought the WTI. They spent the time and the money and the effort to then make a product. And then they put the product into distribution. They put it out in the market and sell it. So they have to know when the demand is going to be there. Gasoline demand goes up in July. They already made the gasoline. They already made it. They made it 6, 7, 8, 9 weeks ago. When oil went from 60 to 100, you're like, oh, that was the war. Yeah, well, possibly. But did you know that we had that mapped out? Without the war, we were going to go to 93. Do you realize we were at 93 an hour ago, and now we're at 92. We're right on schedule. So why does Aiden predict down for WTI? Well, it's what has been happening, but also in his mind, right? I have taught him that refineries will stop buying WTI. They don't need it anymore. Demand just will peter out. So now you got the supply issue. Okay, sure. But what's the issue? Probably more gasoline, right? Is going to be the issue. And we're through the season. Think of it this way. We planted the crop and we've already harvested it. Supply is supply. That's it. It's done, boys. We're done. So now if there's going to be a shortage, maybe there'll be a shortage in gasoline. So prices go up. So should the government get involved and save your inflation souls? You know what the cure is? And Brian was talking about this earlier about, a weak dollar and quantitative easing. Well, we don't really do quantitative easing anymore and stuff, but how do you solve this problem of inflation? Well, it's mostly an energy issue. And in this case, I think we're done. The demand for WTI is done. But now the demand for gas, and maybe because there was a shortage of supply in the WTI world, that maybe they didn't make enough gasoline. All right. So if anything, when demand increases, if there's a shortage of gasoline, when people start going on summer holidays, what happens to gasoline prices? Goes up. Should the government do something about it? No. Should the Fed raise interest rates? No. You know what should happen? You should change your behavior. If you can't afford to put $100 worth of gas in your car, don't go on a trip. Take the Greyhound. Take a Greyhound bus. Dude, they're nice now. I have to go to a board meeting in North Carolina, and it's like a 6-hour trip, and I'm like, I'll take the Maybach. You know what? I might take a Greyhound. I just want to do it. I just want to do it. It's nice. And on the app, you can reserve your seat, and you know your seat in advance, but you can also, for a little bit more, reserve the seat right next to you so no one sits next to you. It's cool. Or you're like, yeah, that's mine too. I might just rent the whole bus. It's my bus. What the hell are you doing on my bus? Yeah. Party time. They have Wi-Fi. I think some of them even have TVs now. Like, I haven't been on a Greyhound bus since 1983. Yeah. Back when Canada could win some Stanley Cups, yo. But, oh my God, that sounds like fun. It's cheaper. I don't have to drive. But change your behavior. That's economics. Government intervention is bad. Oh, they should cut taxes. Why? Because so you have terrible roads to drive on? Okay, then what? What should they do? Dump the Strategic Petroleum Reserve? I'm still mad at Biden for that. We wouldn't have a problem now. So what's the cure? The Fed raising interest rates? What? So you lose your job? Now you have no job and you can't afford to put gas into your car. So what's the solution? Adjust your behavior. That's what the study of economics is. The scarcity. You either have a scarcity of money or there's a scarcity of gas, which makes more money, which means you're back to a scarcity of cash. So you're supposed to adjust your behavior. And I saw shoppers just the other day, and I looked at them. I'm like, they don't care about high gasoline prices. They're out buying lawn furniture for their backyard patio for 4th of July. Like, they don't care. They're not changing their behavior. But if they're leasing that Ford F-150 and their summer vacation is on their credit cards, that's a bad decision. Or should I say a poor decision? They have lots of crap, but they've chosen to be poor. You know what the return on investment of lawn furniture is? Yeah. Yeah, my property looks like a forest now because I just can't bring myself to paying someone $30,000 to trim my trees. I'm like, $30,000 to trim my trees? You know what? Forget about it. That's how God intended it. I'm going to look at my pretty trees, keep my 30,000. You're like, what? It's weird now. I had somebody, I'm like, how much is it to cut down this one tree? $3,000. I'm like, dude, I'm just going to get some dynamite. I'm not going to cut it down. I'm going to blow it up. It'll disintegrate. I can get a lot of dynamite for $3,000. Yeah. Amazing, right? Like, psh. So you got to change your behavior. Yeah. Got to change your behavior. But you got to have the knowledge, right? So this, if I didn't make it clear, the solution to high gasoline is high gasoline prices. We call it supply and demand. We call it capitalism. Okay. Yeah. Change your behavior. Same thing like I think on an airplane, right? I was gonna go on a business trip in like 2 weeks from now, and I looked at it and I pull up the hotel and I'm like, damn, that's too expensive. Like, I don't want to pay that for a cheap room. I mean, I got the money, but I'm like, it just makes me feel sick to my stomach. You're like, so I'm going to be there 4 days and it's $3,000. You're like, oh my God, I'm going to stay at the YMCA, right? And then I'm like, okay, I'll find a place on Airbnb. I don't know. I'll figure it out, but I'm not going to stay at the hotel. It's just stupid. It's just stupid. So then I pull up Delta. I'm like, let's go. Let's go. I'm going to fly on Delta. The cheap seat where I don't even get to pick my seat. And I don't think I even allowed to bring a suitcase, right? Like the starting price, $3,000. Another $3,000. I'm like, I don't want to do it. I don't want to do it. I don't want to do it. I changed my behavior. I have the money. I don't want to do it. It's a change in behavior. I don't just stuff it on a credit card, right? Back to the bus or train. Yeah, but it's Cyprus though, Jim. So, although that'd be killer, huh? Take a boat over to the UK, like land in Ireland, and then somehow take a train all the way to Greece, take a train to Istanbul, and then ferry over. Yeah, probably even more expensive, right? Take a month, $10,000. Yeah. So whatever. So the idea, though, if you're smart with money, you change your behavior. Yeah. That's the solution to the problem. So what happens is demand would go down. So if demand for gasoline falls because people can't afford to drive to grandma's house and they change their behavior, then eventually, because of the lower demand, prices will fall. They will fall. They will fall. See you, Jim. Have a great weekend. Okay, the solution to high prices is high prices that drive a change in behavior. Looks like we got pops and stops. Pops and stops. So that really changed the direction here. We're still technically capable of this. Looks like we had some decent CAD news though, but I'll adjust that a little bit. CAD yen, that could be impacted by the recent news, and we may want to redraw this now. Well, if we breach higher than this, then go from a breakout to a range. Okay. So I'm going to do it this way. If we go higher than this little box, then you go to a range strategy. Right now, there's a bit of hope on this one. So maybe just even kill it. Maybe even just kill that analysis. We adjusted that one. This one probably looks all right. So we have this one going to 140. It's 139. So we have another 100 pips. By the way, we did this yesterday before it happened. We meet every day to plan the next day's trades in advance. How awesome is that? This one completely collapsed on us on a top too. So yeah, definitely back away from that. And I lost almost all my carry trades a few days ago. And I think I'm still in these ones. Yeah. The only thing I have left is these Euro Rand trades, but I was heavily short USD Mexican peso. Remember that? And I am no longer short. Let me go further out here. Yeah. So I got knocked out sort of right kind of where we are now. So I'd been short for a very long time. Does anyone remember 8 months? I had like 9 trades or something. Maybe I got wiped out on this. Maybe I reloaded on this move. So obviously I can't remember. But anyways, got taken out, and now it really looks like it wants to pop up. So I did a decent job on that, I think. Yeah, it would have been that pullback there. So yeah, so we're even above my exit now. So that's good. I did well. I didn't like it at the time, but that's how exits are, huh? I didn't like it at the time. I cried, "Where's all my trades?" And now I look at them like, damn, boy, good job. All right, so what do you guys want me to cover? Let's do trader request. Oh, I forgot to post pictures of me at the food bank last night. I need to post that on social media. You should have seen my beautiful hairnet. Gorgeous. So I put bags of cereal into boxes and then stacked the boxes on pallets. Leverage that Harvard education. How to put a bag in a box. Should write a book. How to Put a Bag in a Box by Wayne McDonald. So anyways, so those carry trades are gone. Only those two are left. I could, for example, well, I definitely should move that stop. Question is, could I move my stop even more? Like, what if we're above 19? I may not like that, huh? So I could move both my stops here and here. So I've been sitting on these earning cash because I get paid every day. And now I've locked in pips. So this one has 4,000 pips, and this one has 1,800 pips. Yeah, 6,000 pips. Good enough. That's my worst case scenario. Now, if I got out now, it'd be more, right? Because that's if I get knocked out at that price. Oh, wow. Meow. Should we be scalping oil today? It's kind of boring. It's a good day for that. I can go to template, and you wouldn't want to do daily, but 5-minute chart. Okay. So you can see this area is when you should start trading oil for the New York session. So this is time-based. That's what that is. That says look for the direction. So it makes a lower low, lower high. Guess what? Sell. Lower low, lower high. Sell. Lower low, lower high. Sell. Lower low. So the next rally up somewhere around the 21. Now, it's not a 21 exponential moving average. It's the future 21 exponential moving average. Sebastian, I believe it's the amount of remittance going back, but nice observation. Yeah. Okay. So we have the future 21, which we're using in real time, but we also have 1 and 2 standard deviations above mean with the linear projection. So we have a slope. So what are we doing then if we're selling oil today? Okay, at this point, the gray box, we know to get ready. During the gray box, it made an up. Let's do thick. Let's do yellow. Okay, up. Maybe it should be blue. Let's do blue. It went up, and then it collapsed with a lower low, up, and then we're outside the box now. And we're using the moving average not as support, but as resistance. Okay, down, 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 up, up, and that was a lower low. Back to hell. Okay, down, 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 up, up, sell. Down, 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 and eventually, guess what? An up, up, and a sell. This is what you'd be doing if you're just scalping WTI. Easy peasy lemon squeezy. Now, I don't have pivot points and stuff on here. This is just for skippity scalping. Now, if we want to do more of a pivot type thing, we can do what, day trading? You want to day trade it, or do you want to swing trade it? We can go to day trading bearish bias, and oops, let's do 1 hour. What do we know? Okay, we know that this is today's sell zone, not yesterday's, not tomorrow's. We knew this yesterday, that today's sell zone is here. Okay, and in fact, if you see, it says bearish selling zone. It's labeled. Okay. The conservative target we just touched, it's labeled bearish conservative target. We knew this yesterday. The extreme target is right there, bearish profit zone aggressive, 91.21. The conservative target for today is $92. And is that a 5 or a 3? I can't see. 3.5 cents. $92.03. Kind of specific. So based on what yesterday's analysis would be for a WTI day trade, okay, the conservative trade wouldn't actually be from that top. It would be from this top. You'd expect a bigger pullback and down there. But since we used the central, look how, I mean, we got so close to it, like literally 2 pennies away from our resistance. And that therefore then projects a lower low. Doesn't have to be. It's just the logic. So we have hit and respected the conservative target, but we should have room to run a little bit more to the downside. And do you know what this is? Monday's trade. Wait, you're still trading today? It's 10 o'clock in the morning. You're still figuring out what to do today? Oh my God, your mother would be so embarrassed. So this got respected because people knew it and they took profit. Yeah. Cool. So you should already be working for Monday, analyzing where the support was, where the resistance would be. And I don't know if people are going to hold through the weekend because of the geopolitics. You just don't know what's going to happen over the weekend, and there's some serious risk. Yeah. Let's get an update on the headlines, and then we'll do a sit rep.
Aluminium. U.S. supply strain risks demand destruction. Commerzbank. U.S. stock markets struggle as tech bleeds and rate hike worries creep in. Euro ECB hiking cycle seen extending to 3%. Nordea.
Canada IV Purchasing Managers Index SA came in at 58.2, above expectations, 55 in May. Look at the drop on the
Gold
S&P.
prices extend losses as strong U.S. payrolls boosts Fed rate hike bets. European Central Bank, credibility costs 25 basis points. TD Securities.
Oil prices ease, but on track for a weekly gain amid Middle East tensions.
U.S. job growth far exceeds estimates in May. Turk Stream gas flows to Europe halted for maintenance.
Okay, we'll move over to a sit rep. Currently, look at that, S&P down, VIX down, VIX up. So stock market down, bad. VIX up, bad. Bitcoin down, bad. Gold down, bad. Oil down, good. Dollar up, bad. Yields, oh no, the 10 is over 4.5, which means the 30 is over 5.0. Oh my God. Terrible day. Risk, right? Risk is dropped to 1, which means today is a nasty negative. That's no good.
Good morning. Let us get you up to speed. Today's market sentiment is best described as flat and indecisive, reflecting a notable pause compared to the stronger risk-on trends seen over the last 30 days. I am seeing the U.S. 10-year yield push higher to 4.536%, which is creating a clear divide between the resilient Dow Jones and a bleeding Nasdaq, as the U.S. dollar index strengthens against most G10 peers. 1. I am keeping a close eye on the latest numbers for you. U.S. job growth for May really knocked it out of the park, coming in way higher than anyone expected, though the unemployment rate stayed steady at 4.3%. Up in Canada, the IV PMI was a pleasant surprise, hitting 58.2 when people only expected 55. Gold is taking a hit today because those strong job numbers make it more likely the Fed will keep interest rates high. Meanwhile, oil prices are cooling off a bit, but everyone is still watching the Middle East very closely for any new tensions. Biggest movers right now, Ethereum, silver, Bitcoin, and Nasdaq 100 are down. VIX is up.
Cool, huh? Can you believe I give this to you for free? You know how expensive doing this is? Oh my God. That is a great summary. Thank you, Aiden. So again, we have AI watching the news for you, watching the economic data, watching the charts, analyzing everything in real time and putting it into human context. Yeah. And no ChatGPT, no Gemini, no Copilot. Yeah. Yeah. Our private owned large language model that only TradeRs has access to. All data driven, and all I taught the AI, Aiden, how to trade and invest. So he only knows what I've taught him, and he has no access to any other pollution. Because if you ask ChatGPT, it goes out into the internet and searches for all the stuff on the internet on how to trade Forex, as an example. The thing is, 95% of traders lose money trading Forex. So it's all BS that's out there and a bunch of YouTube gurus trying to sell books and courses, but it's all BS. So Aiden doesn't even have access to that BS, that fake news, if you will. He only knows what I've taught him. And when I look at it, this is what I think, which is extraordinary. So most of everything that you saw today is free. There are some things you can upgrade to if you choose to, but you're going to be amazed on what you get for free. So swing on by. It takes seconds to sign up. Seconds. There it is. You enter in your email and you're in. You want to know more? Scroll down. Yeah. And you'll get hundreds of dollars of value for free. And then you can upgrade a little bit more if that's what you want to do. Peace on earth. May the pips be with you. May your profits be above average. Have a wonderful weekend. I'll see you soon.